Good morning, everyone. We'll get started in about 2 minutes. We'll let folks kind of filter in a bit. Okay, well, it is 10:02, so as promised, we will get started. And just so everyone is aware, we are recording today's webinar. I plan to share this out in a follow-up email shortly thereafter our webinar ends today. But welcome, everyone. My name is DeMarcus Andrews. I am the Director of Outreach and Engagement and the North Carolina Policy Manager at the Center for Responsible Lending. I'm also the Chair of the Steering Committee for the NC Coalition for Responsible Lending. And at CRL, we work to ensure a fair and inclusive marketplace that creates opportunities for all creditworthy borrowers. And the North Carolina Coalition is an extension of the Center for Responsible Lending. The coalition keeps community informed about current threats and opportunities, and we use a variety of advocacy tools to achieve high impact reform that builds and protects wealth for marginalized communities. I really appreciate you all joining us today to learn more about student loan debt cancellation. And you'll hear me throughout our conversation refer to the Center for Responsible Lending at CRL, just so you are aware and that I'm bringing you along with me. But CRL has been deeply involved in the effort to cancel a portion of student debt for years. And our research demonstrated that across the country, and specifically in North Carolina, that students and their families were taking on more debt to pay for higher education. Our state and federal policymakers were not investing as much in higher education, so the cost increased dramatically. And adjacent to that, wages did not increase at the same rate. So all of this meant that when leaving school, students in North Carolina owed 3 times as much in 2019 as they did in 2009. And even as the cost of education, kind of set more heavily on students and their families, the companies tasked with collecting payments, called servicers, repeatedly demonstrated that they could not or would not provide accurate advice to borrowers. Their misstatements cost borrowers millions, dramatically increased their loan balances, and forced them to continue paying months or even years after their loan should have been forgiven. And even during the payment pause, many services got out of the business. So this means that new services are getting ready to do a lot, all at the same time. And just to name a few of them, so you have millions of new borrowers that are re-entering repayment in January. You have the administration that is canceling a portion of debt for millions of borrowers nationwide. And they're implementing, really dramatic changes that are temporary to the PSLF program. And there are changes to the income-driven repayment plans, and that's just to name a few. And so the expectation at CRL is that this will not happen seamlessly and without harming some borrowers that are entitled to one or more of these benefits. So at this point, there's 19 states that offer student loan borrowers some consumer protections to better protect them from servicing mistakes and abuses. And North Carolina hopes to join these states. And the need is particularly acute this year. So with so many changes coming into the field of student loan servicing, it is likely that there will be problems. And as I mentioned, there's just, a number of different changes at one time. And there was already problems existing in the servicer space. So this will exacerbate. So North Carolina student loan borrowers are more vulnerable than those in many other states because we lack the standards set for services. CRL and North Carolina Coalition for Responsible Lending will work hard next year to pass legislation to ensure that students and state regulators can hold servicers accountable when they harm our residents. And I call on you to join us in this effort. And you can sign up to receive updates about this campaign with a link that will be dropped in the chat. But we need your help. We need to make sure that North Carolina protects the 1.4 million student loan borrowers here. And so with that background, I will move us into the substance of our webinar today. I'd like to first introduce you to our special speakers today. We have Jaylon Herbin. He is the Outreach and Policy Manager at CRL and the Student Loan Lead. In this role, he focuses on outreach development and student loan debt. Prior to joining CRL, Jaylon served as the district liaison for Congresswoman Alma Adams, North Carolina's 12th Congressional District, where he was responsible for stakeholder engagement and policy review through constituent services. Throughout his professional career, Jaylon has cultivated his skills in relationship building, organizing, and advocating. Jaylon graduated with a BA degree in political science from Winston-Salem State University. He is currently pursuing his master's in public policy from Helms School of Government at Liberty University. In his spare time, Jaylon enjoys spending time with his family, traveling, coaching basketball, and playing golf. And we also have Arthur Bartlett. He is the director of North Carolina Low Income Taxpayer Clinic and Legal Services for the Elderly at Charlotte Center for Legal Advocacy. Bartlett holds a BA degree in political science and history from the University of Vermont and a JD from the University of Michigan Law School. Before joining Charlotte Center for Legal Advocacy in 2007, he worked in private law firms in Buffalo, New York, and Charlotte, specializing in URSA and executive compensation. Bartlett's work at the Center for Legal Advocacy provides him the opportunity to fulfill his personal mission of living a purposeful life by helping those in greatest need with the lawyering skills he's so fortunately acquired. What he enjoys most about his role is the opportunity to make a meaningful difference in his clients' lives. In his free time, Bartlett enjoys spending time with his family as well. I appreciate you both being here today, and I look forward to the content you all will share with us. And before we jump into the webinar, into the recording, I want to take care of some housekeeping. So the plan for today is to show a short recording of a presentation from Ashley Farrington, who's a former CRLer, but who's the current senior advisor to the COO of the U.S. Department of Education regarding the recent announcement of 10K or 20K in debt forgiveness. We will then have a short presentation from Jaylon Herbin, who will expand on what is discussed in the recording. We will then follow that up with a presentation from Arthur Bartlett about the tax implications of debt forgiveness for North Carolina borrowers. And then we'll save about 10 to 15 minutes for Q&A. And as we move along, please feel free to drop your questions in the Q&A box, and I'll definitely get to them when we get to that portion of our time together today. So with that, Eric, do you mind playing the recording for us?
Sure thing.
Ashley Harrington, really happy to be here. Many of you may know I used to work at Center for Responsible Lending, but I've been at the Department of Education for a little over a year now. Now I'm going to briefly talk about one-time debt relief that was announced on August 24th because it's very exciting. So, we announced one-time debt relief of up to $20,000 for borrowers who received a Pell Grant in college and meet the income threshold, and up to $10,000 for borrowers who didn't get a Pell Grant in college and meet the income threshold. And the income threshold is $125,000 for borrower who filed individually, and that's based on your 20 or 2021 AGI, or $250,000 for married couples, and again, your 20 or 2021, whichever AGI counts. And most federal student loans are eligible. Undergrad, grad, parent plus, grad plus, consolidation loans, FEL loans, and Perkins loans that are held by ed, defaulted loans. So the way I like to think about this is if your payments were on the payment pause and they weren't accruing interest and you didn't have to make a payment, they are eligible for student debt relief and you can get access to this. Remember, for consolidation loans, if they had commercial FEL loans, you had to have consolidated by September 29th of this year to get one-time debt relief if there were commercial FEL loans. So if you had loans that weren't on the payment pause, you had to have already consolidated for one-time debt relief. Remember, these are separate things. And I had a slide called How to Prepare, but actually you take it out because the application is available. In case you weren't aware, the application was tested over the weekend and it went officially live yesterday. We've already had 8 million people apply, so it's working. Studentaid.gov/debt relief/application is super easy. You may have seen all of the memes and back and forth on social media about how people are doing it very quickly in places they probably shouldn't have done it, like while they're driving, and they should probably be looking at the road. But it just proves it's very simple. A few short questions, confirming your basic information. You don't even have to log into your studentaid.gov account. You attest to your income, and that's it. You don't even have to upload documentation. If we need something else from you, if you're selected for verification, we'll follow up with you later, but it's that simple. It takes less than 5 minutes, and 4 to 6 weeks from now, as long as you have federal student loans and you meet the threshold, right, you're gonna be able to get your relief. And we're encouraging everyone to apply by mid-November so that you can get your relief before repayment resumes in January. So for the application, studentaid.gov/debt relief/application. For general debt relief information, studentaid.gov/debt relief. Here's how you can contact your servicer if you need help with something. Here's how you can reach out to FSA on social and be on our contact center. And now we have a bunch of time for questions.
What date did borrowers with commercial FEL loans need to consolidate to qualify for the one-time forgiveness?
They had to have submitted their consolidation application by September 29th.
If you are still in school, can you still apply for the one-time debt relief?
Absolutely. It's available for our loan. Anybody who has loans that were dispersed prior to June 30th of this year. So current students are absolutely eligible. And actually many current students will likely be eligible for automatic relief because they probably submitted a FAFSA in 2020 or 2021 and we have their income information already. We started notifying people eligible for one-time relief, I think today, and we'll keep doing that over the week.
Well, thanks for that, Ashley. And Jaylon, I really appreciate y'all putting that webinar on. It was super informative. But I will now pass it to you, Jaylon, to expand or add anything, from the recording on debt forgiveness.
Thank you for having me first. And that event, like DeMarcus said, was an event that we had last week with a lot of our stakeholders. My name is Jaylon Herbin. As DeMarcus gave the great introduction, I do need to get out to the golf course pretty soon, though. But I had the pleasure of serving as our student loan lead for the Center for Responsible Lending. You'll hear me say CRL because that's just the acronym that I love to go by. It's a lot to say when I'm giving out a lot of details and stuff throughout this presentation. So I want to back up and sort of give you a brief overview of our student loan debt. As you saw in North Carolina, there's 1.4 million residents. And of that, the average student debt here in North Carolina is approximately $36,293 here in North Carolina. To go a little bit more into depth, here in the federal government, you have $1.9 trillion student debt crisis now, and that impacts over 44 million families. So of that, like I said, you have around the 10.5 million residents here. We have 44 million families nationally. But it doesn't just stop there. Black women in particular, hold 2/3 of the student debt. Women hold 2/3 of the student debt. And then Black women take out $10,000 more than the white male when they go into college, undergraduate and graduate degrees. The one thing that we have seen that has impacted communities of color even more is the repayment process. Because of the time frame that it takes to pay off student loans from 13 years from the time that they graduate, the white borrower has decreased their student loan by an average of 95%, while the Black borrower, or borrower of color rather, has increased theirs as well. Due to the interest in the repayment, having access to great salaries, as well as the interest that they're accruing and the resources to be able to pay it off in a timely manner. Now, out of that, there was a big announcement that President Biden announced on August 25th from the help of Center for Responsible Lending, CRL, NAACP, some of our civil rights organizations, the North Carolina Coalition for Responsible Lending, our faith leaders as well. We were advocating for student debt cancellation. While we advocated for $50,000 of the student debt, we did not receive that in the announcement. However, we did receive $10,000 of student debt if you make $125,000 or less, or for a household, $250,000. Now, if you receive a Pell Grant, you qualify for additional $10,000. So instead of it being $10,000, you will receive $20,000 if you meet those stipulations, requirements, means testing. To be clear, we did advocate for no means testing, and we did advocate for it to be broad cancellation and automatic cancellation. Reason being because we did not want to allow this to hinder anybody from being able to receive the relief that they deserve. So through this announcement, you have $10,000 or $20,000, depending on if you meet those requirements. Out of that, we are now looking at an additional, what he's put in here is that you will now, your discretionary income for IDR, for undergraduate loans, will be capped at 5% of your discretionary income. That is a huge change. So right now, I believe it's at 8%, is 8% or either 10%, I can't remember off the top of my head right now, is what they are using as the cap for your discretionary income when you are enrolling in an IDR plan for your undergraduate loans. So to decrease that by 5% is a significant change. On top of that, Parent Plus loans are now included in this forgiveness that can apply for total loan forgiveness. At one point, we did have FEL loans. Now, FEL loans are a federal loan that is backed by or guaranteed by the federal government, but are given by a private sector. Typically, Wells Fargo is one of the biggest financial institutions that are offering these loans. Before September 26th, if you had applied to consolidate your loans and everything, then you would be able to qualify for this. However, due to a lot of legalities and the complexity, they had stopped this. And hopefully we are in the process of navigating through this right now to be able to bring back our FEL bars and have them receive this opportunity of student debt forgiveness. Now, what I would like to do now is talk about our public service loan forgiveness waiver. You have it till October 31st. So a public service loan forgiveness waiver is for teachers. It is for nonprofits, first responders. It is for core members. And when I say core members, like Teach for America and a few others, and give you a rundown of the list actually that qualify: firefighters, doctors and nurses, government employees, police officers, U.S. military, nonprofit employees, teachers, faculty and school staff, and Peace Corps. They all qualify underneath the Public Service Loan Forgiveness Program. Now, what's different about this Public Service Loan Forgiveness Program is that if you had a loan that did not qualify, but you are employed by a qualified employer, you can consolidate your loans, and the payments that you have made prior on that previous loan will now count on this new loan when you consolidate it. So say, for instance, you worked for a nurse, you are a nurse, and you've already had your 10 years of service, and you have been paying 120 payments on time and everything else on one loan, but that loan did not qualify for public service loan forgiveness. If you consolidate now, you are now eligible to have your loans discharged, total forgiveness. So that is why this is such a special program, and why we are advocating for everybody to enroll and do the waiver. And one thing that I will say, if you go through the Help Ninja tool on FSA and you do it by October 31st, you do not have to have them certified or signed off by your employer on the 31st. And you can still turn it in on November 2nd, 5th, 31st, or whatever the case may be. Did I just jinx myself? I only think it's 31 days in November, but yeah. But you can still submit it. It just has to be into that tool or in that portal by October 31st. Now, people are asking, well, why do the waiver and they offer the relief? Because some of the relief that you are going to receive from the student debt relief, the $10,000, $20,000, you may still have, a decent portion of your student loans remaining. You may have an additional $10,000 or $20,000 left after the $10,000 and $20,000 cancellation or relief is given to you. So go ahead and apply for that. And if you are, certified or qualify for the public service loan forgiveness, then also do that. Now, there's one additional program that you have. It's called the income-driven repayment. I spoke about that a little bit earlier on with President Biden and his announcement where they capped the undergraduate discretionary income to 5%. Go ahead and enroll for IDR as well, because now that you have student debt forgiveness or student debt relief rather, and now you have the public service loan forgiveness waiver based off of your income and your income to debt ratio and a few other things that they put into this equation, they're going to give you a new monthly payment. It could be lower and now it could be higher. We have to express that and tell you that, but it's also always worth going ahead and asking them, what are my benefits of enrolling in IDR? And it will help you out as well, because with IDR, those are two routes to get student debt forgiveness. So you have public service loan forgiveness, which is a 10-year, 120 consecutive payments. Now, I will say that through the negotiated rulemaking committee that I served on, and through this previous final rule that we are waiting on by November 1st to be released, we advocated to have that change from 10 years to 8 years. So instead of it being 10 years and 120 consecutive payments, it has to be 8 years with, I believe that is roughly, I can do the math right here in my head, 96 consecutive payments. So if you are 8 years into your service and you've made 96 consecutive payments, and let's say, for instance, you did the waiver and it showed that you already had 98 payments, and by the time this new rule is implemented in by November 1, and it's 8 years, and you have 8 years of service and you already have the amount of payments, your loans are going to be forgiven as well. So going back to IDR, with income-driven repayment, it is a 20 to 25 year payment where they will put you into this program, and then they're going to look to see what is the best, monthly payment that you need to pay based off of that equation that I just told you. So your income to debt ratio, also what other loans you may have out, assets, and wealth that you have already accumulated as well. They're going to give you this total, and that's what you don't pay. You have to recertify every year, however. That is the only difference between IDR and PSLF. You have to recertify every year for this program. Now, let's talk about the implementation of the student debt relief. Right now, it has been a legal battle. It is being held up right now in the 8th Circuit Court, where there are 6 AGs that have filed the student debt relief. President Biden does not have the authority. To be clear, President Biden received his authority from a memo that was done through research from the Harvard Institution, as well as from the DOJ as well. And it states that he actually does have the power, but the power falls underneath the purview of the Secretary of Education. Secretary of Education is the one who has the authority. President Biden has just asked Secretary Cardona to execute this order for him. Now, with this being said, if you live in 6 states, I believe 6 or 7 states, you will receive a tax. It will be taxable income. And Arthur is going to talk about that a little bit in a second. But federally, there will be no taxes that will come along with this. And the way they don't implement this is if you apply for student debt relief, and the application is open now. It just opened a few weeks ago. Last weekend, matter of fact, they did a beta application and it went live on Monday afternoon of last week. 22 million borrowers have already applied for this, and they're anticipating out of the 44 million borrowers or 44 million families that are impacted, 40 million borrowers will qualify for this loan forgiveness. So 22 million borrowers have already applied and are waiting for their relief. If you apply by mid-November, given after all of this legal battles have shaken, when they get the green light and say that they are eligible to give student debt relief, by November 1, you should see that $10,000 or either $20,000 of student debt reflected in your account. So I gave a lot of information, but I want to just lastly leave you with some important dates here. October 31st is the deadline for the public service loan forgiveness waiver. Please go into your FSA portal, into your account, go in and go to the Help Ninja tool. When you do that, even if you have not received your signatures by October 31st, you are still in good standing to send it over to FSA, and it's going to go to the MOHELA servicer. Next one is right now, we can't even say we're waiting for it, but right now on FSA, studentaid.gov, you can go and apply for your student debt relief, and that is open until December 2023. However, if you complete it by mid-November, you will now receive your relief by the 1st of January. And give or take, it is a process, and there's, like I said, 22 million borrowers have already applied. It's by sometime in January, beginning of the year, you will see that in your account. And that is what we are holding them to and holding their word to. So I will stop right there, and I'll kick it over to my good friend Arthur to talk about the taxes that come with this.
Thank you, Jaylon. I think we're waiting for the presentation to switch here. Let me just reintroduce myself. I'm Arthur Bartlett from Charlotte Center for Legal Advocacy, and I've been the director of our low-income taxpayer clinic for about 15 years. I'm now co-director with another attorney I work with, Soray Finley, and we generally help North Carolina taxpayers who have issues with the North Carolina Department of Revenue or the Internal Revenue Service. So that's my primary function here at the center. And today I'm here to talk about the tax implications of forgiven student loans, specifically student loans that are forgiven under the Biden administration's debt relief plan. Next slide. So I want to talk about three things today. The first is the federal taxation of student loans under the Biden administration's debt relief plan. The second is North Carolina's taxation of those same forgiven loans, and then what this means for tax filers for the 2022 tax filing season. So when you file your taxes early next year for 2022. Next slide. Okay, so the general rule when a debt is forgiven is that that amount that's forgiven is taxable income to the person for whom the loan is forgiven. And so the general theory is that when a loan is made to a taxpayer and then the creditor says, I no longer am going to attempt to collect that amount from you, it's as if the creditor simply gave you the money. And that's why federal law generally treats, under Code Section 61A12, forgiven loan as income or discharged debt as income. And so that's the general theory. But Congress and the president and the government over the years have put into legislation and into the code certain provisions that allow for exceptions to this general rule. So you could think of any number of instances where you wouldn't want the taxpayer to have to pay tax on that forgiven income. And so the code has a section that lists all of those different exceptions to this general rule. Next slide. So the exceptions. So there are many, and some of them are statutory, like I indicated, some of them are from case law, but they're all found, the statutory ones, in Code Section 108. And that's where we're going to find the exception for loans that are forgiven under the Biden administration's debt relief plan. Next slide. So the American Rescue Plan Act of 2021 provided a whole host of relief to Americans during the pandemic. It was one of several bills that had provided assistance to Americans as we fought off COVID-19 and we're dealing with the ramifications of what it meant to live, during that period when COVID-19 was sort of raging across the United States and still and had sort of dire economic impact in 2020 and bleeding into 2021. So this was the third of a series of pieces of legislation that was meant to address COVID. In that piece of legislation, there is a provision that modified the treatment of student loan forgiveness and created a whole new section that said that basically, if you have a discharge of student loan that occurs in calendar year 2021 through 2025 for certain educational expenses, that amount will not be treated as income to you for federal tax purposes. So the $10,000 and the potentially $20,000 of loan forgiveness under the Biden administration's debt relief plan, those amounts for federal tax purposes will not be treated as income. So the Biden administration had the foresight when they passed this piece of legislation to write into it a provision taking care of the tax treatment of those amounts, basically saying, you know what, they're not taxable. We're trying to provide real relief to people. We don't want to tax them on the forgiven amounts of debt that they're going to receive later on. And so they had an eye towards some sort of debt forgiveness for student loan borrowers, and they had the foresight to build in this provision. Next slide. Okay, so this is the code provision. So this is section 108F, and it talks about exactly what I just mentioned, which is basically for tax years 2021 through 2025, gross income, which is a fancy term for, you know, the amount of money you earn and other income that you receive, those amounts under the Biden debt relief plan will not be treated as income. And it goes through the list of loans that qualify under Section F. And we saw some of them mentioned in the presentation, although here they're denoted by, you know, the sections of the code and the various laws that apply to them. So again, we're saying the same thing. It's really that $10,000 or $20,000 isn't going to be treated as income for federal tax purposes. So, you know, when you go do that 2021, 22, 23, 24 tax, 25 tax return, if you've had loans that are forgiven in those tax years under this Biden program, they're not going to be treated as taxable income for federal tax purposes. Next slide. Okay. So the mechanics of the discharge. Importantly, the Biden administration, in a notice issued by the Internal Revenue Service, indicated that lenders of student loans that are forgiven under the Biden program are not required to issue what is called a Form 1099-C. So generally, when a debt is forgiven, the creditor, to inform the IRS and to inform the taxpayer of the canceled debt, they will send a copy of what's called a 1099 information statement. It's simply a form filled out with the particulars of the canceled debt to the IRS. They'll send a copy to the IRS and they'll send a copy to the taxpayer. So here the Biden administration is saying, hey, if there's a loan that has been forgiven under the Biden debt relief plan and is excludable from income under section 108 F5, then lender, you don't need to send this form to the taxpayer and you don't need to send it to the IRS. So when you go to the IRS and you look up your wage and income transcript for the year in which the debt was canceled under the Biden relief program, you won't see on that wage and income transcript any information about that canceled loan, because the lender is, again, not required to send in this form to the Internal Revenue Service, and they're not required to send it to the taxpayer. So this is important because when we talk about state tax law, that's going to perhaps make it more difficult for taxpayers who are here in North Carolina. So just keep that in mind, that there will be no 1099-Cs going to the IRS or to the taxpayers from the lenders. And it looks like I have a bunch of Q&A questions. So I'm trying to see how many of those are for me.
Oh yeah, I can handle that for us, Arthur.
Yeah, I'm wondering if I should stop now. How does I don't think any of them are for me necessarily. So I'm going to keep going. So next slide. Okay, so the takeaway for federal tax purposes, the takeaway is if you are a borrower, a student loan borrower, and your loan is forgiven under the Biden administration's, and it's not an executive order, this is a sort of a misnomer, and it's excluded from income under section 105F, then the amount that's forgiven is not income for federal tax purposes. And just to sort of clean up what I wrote here, executive order, I believe the administration is relying on provisions in the CARES Act to find the statutory authority given to the Department of Education to provide this relief. So just to clean that up a little bit. But again, the takeaway, not taxable income if you receive loan forgiveness under the Biden student loan debt relief plan, either that $10,000 or $20,000. Next slide. Okay. So what about public service loan forgiveness program and income-driven repayment? So borrowers who are, we talked about this just a minute ago, if you're able to take advantage of the public service loan forgiveness program, then those amounts for federal tax purposes are not income to you. They are not income, and the provision of the code that excludes them from being treated as income for federal tax purposes is good old section 108 F1, not F5. So there's a section, a separate section, subsection of code section 108 that provides relief for borrowers who receive public service loan forgiveness under the public service loan forgiveness program. So no income for them at the federal level if they receive relief through that program. And the same is true for those individuals under North Carolina law. So North Carolina law in this respect conforms with federal law and makes it so that any amounts forgiven under the public service loan forgiveness program are not treated as income for state tax law purposes as well. But income-driven repayment, when the borrower reaches the end of an income-driven repayment plan, we know that any balance that remains is forgiven, but that amount is subject to taxes. So that is an important distinction between a lot of the things that we're talking about here, and just something for borrowers to keep in mind. Next slide. Okay, state tax law, and this is where it gets a little bit messy for North Carolinians. So in November of 2021, the state of North Carolina passed a bill, and it's listed here, and Governor Roy Cooper signed it into law, that brought into conformity North Carolina law with the majority of tax law changes that are embodied in the Internal Revenue Code as of the date listed here, which is April 1, 2021. So basically, the state legislature and the governor, when he signed this bill, they went and they looked at state law, federal law, tax law as of April 1, and they adopted pretty much all of it so that it corresponds in large regard, in a large respect with federal law. So they brought it into conformity with federal law in many, many ways, but there are some exceptions. Next slide. And those exceptions are where the state has decoupled state tax law from federal tax law. And one of the areas where they decoupled state tax law from federal tax law is the exclusion from income under section 108 F5 for taxable years 2021 through 2025 for amounts forgiven under the Biden administration's debt relief plan. So put more simply, we talked about how amounts forgiven under section 108 F5 are not taxable income for federal tax purposes. The state is saying through the enactment of this decoupling provision in that 2021 law that any amounts that rely on section 108 F5 at the federal level for exclusion from income are considered income for state tax law purposes. Next slide. And so the state Department of Revenue, the North Carolina Department of Revenue, issued a statement on August 31st confirming this result and saying that because of the decoupling that's in state law, amounts that rely on section 108 F5 at the federal level to be excluded from income are considered taxable income for state tax law purposes. So this is huge for North Carolina borrowers. And we talked about how there are some things that are going on at the federal level that could make it a little more difficult for borrowers who receive relief under the Biden administration's debt relief program to file their taxes in 2022. So next slide. Okay, but first, the takeaway. So currently, North Carolina treats a student loan forgiven under the Biden administration's loan debt relief plan that is excluded from federal income under Code Section 108F5 as income for state tax purposes, just to drive that home one more time. So next slide. Okay. So what are the issues here? Well, North Carolina taxpayers shouldn't have any problems filing a federal income tax return because, again, no 1099-C is going to be issued to the taxpayer or to the IRS. And there's a clear exclusion from income under Section 108F5 of the Internal Revenue Code for amounts that are forgiven, either that $10,000 or $20,000 under the administration's loan forgiveness plan. But what about North Carolina? Well, if you don't have a 1099-C issued from the lender indicating the amount of the canceled debt, it's going to make it a lot harder for North Carolinians to show their tax preparer exactly how much debt was forgiven in a particular calendar year, whether it be 2001, 2, 3, 4, or 5 under the plan. So as a taxpayer, again, filing your federal tax return early next year if you receive loan forgiveness this year should not be a problem, but there might be a problem when you're trying to give your tax preparer accurate information about the amount of the forgiven loan. Next slide. Okay, so what about exceptions other than the exception in 108F5 for forgiven student loans? So if we go back to, and I don't want you to go back to the prior slide, but if we think about the decoupling of state law from federal law, well, that really only pertained in this context to loans that rely on that code exclusion under Section 108F5 to be excluded from income. There are a whole host of other exclusions from income for forgiven debts in Section 108, and one of them is for insolvency. So to the extent that a borrower is insolvent at the time that they receive relief under the Biden administration's debt relief program, they can exclude that amount from income under Section 108F2. And so here, when we think about insolvency, insolvency is really the difference between your total assets and your total liabilities. And this is the worksheet that the IRS provides to help taxpayers figure out if they're insolvent and then to figure out by how much. So you can see here on the liability side, you list basically all of your liabilities at the time that that debt in question was canceled. And so at the top, you write down the date the debt was canceled, then you total up all of your liabilities and it has these different categories, and then you total up your assets. And so you used your sort of a good faith judgment when you're doing this and engaged in this to figure out if you're insolvent and the degree of your insolvency. Next slide. Okay, and we can see there, oh, I'm sorry, it's Section 108A1B is where the insolvency exclusion is. And so that's what we're relying on here. And again, if you are a person who is insolvent at the time you receive this debt relief, and you calculate, then you calculate how insolvent you are, and you could exclude that amount from income. So let's say that you receive $10,000 of loan forgiveness in tax year 2021. You go through the worksheet and you find that you are insolvent in the amount of $8,000. Well, then under this provision, you could exclude for state tax law purposes $8,000 from your income, and you only have to recognize the two as income for state tax purposes. Okay. So you have to go through that calculation to see the extent of your insolvency. If you're insolvent by $25,000 and you receive $10,000 of loan forgiveness, well, then none of it has to be treated as income for state tax law purposes if you rely on this provision, 108A1B. Now, the trick to doing that is that you need to think about whether you want to rely on that provision when you're preparing your federal tax return, and then you pull that down to your state tax return. So remember, your tax preparer will probably think, okay, well, this is loan forgiveness that falls under 108F5, so I don't really need to do anything, and then I'm just going to pull that information onto the state return, no problem. Well, that is a problem because, like we talked about, if you rely on 108F5, that doesn't carry through to the state return. That income will show up on the state return showing the amount of the forgiven debt in tax year 2021, if that's the tax year in which you received the forgiven debt. What you need to have the tax preparer do is rely on this exclusion, the 108A1B insolvency exclusion on the federal return, and then that'll get pulled down to the state return. But of course, we talked about how you're not getting a 1099-C. So you'll have to provide some other evidence to the tax preparer showing the amount of the canceled debt so that they could properly prepare the federal return and the state return to rely on this exclusion. But of course, this won't be everybody. This will be some small or some size of subset of the loan borrowers who will receive forgiveness. It's just something to think about. If you feel like you might fall within the parameters of this exclusion, it might be worth having a conversation. Well, it definitely would be worth having a conversation with your tax preparer. This is all very complicated. Talk to your tax preparer. So next slide. Okay. And so importantly, one of the forms that gets filled out on the federal return and included with the federal return is this form 982. And this is where you tell the federal government, and then when the state pulls down information from your federal return, it tells those governmental authorities which exclusion you're relying on. So here, there is discharge of indebtedness due to insolvency, and then you note the amount or degree of your insolvency here on this form. So this is the form that the tax preparer needs to be aware of if you're relying on that exclusion for insolvency, and this must be included with the federal tax return. Just to make this even more complicated, some tax prep software does not include this form with the software itself. You have to buy like an extra enhanced package to get access to this form. And some tax preparers may not have access to this form with the software they use. So be very careful about the preparer you go to, careful about the software you're using, and make sure that if you're trying to rely on that insolvency exclusion, that this form gets included with your federal return and all the proper information ends up on that federal return so it flows through to the state return. Next slide. And of course, this is the legalese because I'm an attorney. So my analysis here should not be construed as tax advice. This presentation represents my best interpretation of how North Carolina law is likely to treat student loan debt canceled under the Biden administration student loan debt relief plan as of today, and nothing in this should be relied on for tax purposes. Really go to your tax preparer and work through these issues because every situation is a little bit different, and you don't want to rely on something you've heard today, especially when this situation is fluid and changing. And there's still hope that at the state level that we might receive some guidance from the North Carolina Department of Revenue indicating that perhaps these amounts are not income for state tax purposes. I don't know how that'll play out, or maybe there'll be a legislative solution at the state level. Probably not in this period, but again, there's always hope that cooler heads will prevail at the state level, because no matter where you sort of end up on the fairness of the forgiveness of student loans, this situation makes it more complicated for state taxpayers to prepare their returns and to know what to do. And so I think it's incumbent upon state officials to sort of recognize that there are all these potential pitfalls for people who are trying to do the right thing when they fill out their state returns. And this situation makes that harder. It makes it harder on state taxpayers to know what to do it properly, and to file their returns. And we want people to be in compliance with our tax code here in the state of North Carolina. We want them to have as easy a time as they can filing their taxes. And this situation of decoupling makes it harder, just like it did with the mortgage debt forgiveness. So there's another section in 108 that deals with forgiveness of principal mortgages on principal residences, and there the state decoupled as well. And we've seen a whole host of problems with that. People just don't understand. So that's my presentation for today. And if you have questions that occur to you after this presentation, feel free to email me. I think my email is on the very next slide or the one after that. Yeah, there it is. Feel free to email your questions, and I will get back to you as soon as I can. It's been a pleasure. Thank you so much for inviting me to speak, by the way.
Absolutely. Thank you, Arthur. And thank you, Jaylon. Thank you both for your informative presentations. It's timely, very important. So I really appreciate the content that you all have presented today. We will now move into the Q&A segment of our time together, and we have some nice buffer time in, and so we can get to all the vibrant questions in the Q&A box. And I will get us started. So Jamie, at the beginning, and I think, a few of the questions have been answered throughout the presentations, but I want to just pull that information out just so folks can walk away with some answers. So Jamie mentioned that they have Phil loans that they've been paying off since 2005. It was a private loan. Are they eligible? And I think this was the portion of your presentation, Jaylon, where you were talking about the forgiveness. And so whether they still qualified for the forgiveness piece if they have private loans.
Yeah, so 2 steps here. And I thank you for this question. When I say forgiveness, if it is a federal loan, excuse me, I can't even say federal owned, and I'll tell you why in a second. If it is a federal loan, then yes, you qualify for student debt relief. Now, the reason I said I can't say federally owned, because the FEL loans, due to the legal complexities of the case here with AGs, the White House ended up striking out the FEL loans and taking them out of the forgiveness. So if you do not qualify to consolidate your loan or to apply for that by September 26th, then you are no longer FEL loans borrowers do no longer qualify for student debt relief. You cannot even consolidate it anymore. You had to do it before the September 26th, before they removed it due to the strength of the case, and to weaken the case so that we can have full relief. So that is the one thing right there.
Gotcha. Thanks for that, Jaylon. This was another question that came from Jamie. They mentioned there was a nonprofit employee for over a decade, including 5 years at Self-Help, and now work at Duke University School of Medicine. They tried before for forgiveness, but was denied because they had FIL private loans. I consolidated my loans within Navient several years ago. Might I qualify for PSLF?
So I cannot say yes or no to this question. Due to the fact that you did consolidate your loans, that is a good thing, and you consolidated under a federal servicer at the time, Navient. Navient is no longer a federal servicer due to they have actually went in and restructured. And to be completely honest with you and transparent here, Navient was also one of the servicers that was putting borrowers in forbearance and what we call forbearance steering at the time. It was at the heart of a huge, I don't even say burden, but legal ramifications that took place here due to a lot of the forbearance steering that they were offering. So one of the things that I will say is that Navient, they have now transferred their loans to Aid Advantage. They are now the federal servicer that has taken on the contract and that are now taking on the accounts for Navient. So what I will recommend you doing is, one, go ahead and put the public service loan forgiveness application in right now, but also reach out to Aid Advantage to make sure that your loans are no longer a fail loan, but as you stated, they were Navient, so make sure they're with Aid Advantage. But if you did consolidate prior and change them from fail to Navient, then you should qualify under my expertise here. But again, I'm not a servicer. I'm just a consumer advocate.
No, that's helpful, Jaylon. And Arthur, a question for you. Could you provide an example of a taxpayer who received $10K of one-time debt forgiveness who qualifies for the insolvency exemption from income? And could that look different from someone who recently graduated than for someone who has been in repayment for 13 years and has managed to purchase a home, for instance?
So yeah, the example, the sort of clean example of somebody who receives $10,000 of loan forgiveness this year and would qualify for the insolvency exception is somebody who simply, when they're adding up their liabilities, has a lot of liabilities and doesn't have much assets. So typically that would be somebody who doesn't own a home or have a lot of equity in the house. It would be somebody who has a significant amount of maybe student loans on the liability side, with perhaps some consumer debt of some kind, credit cards, outstanding car loans. I mean, most people, you drive a car off the lot, it's going to be worth less than what you owe on the car. So, you know, your typical sort of average North Carolinian who might be insolvent is somebody who has student loan debt, who has some credit card debt perhaps, and has car loans, maybe one or two. And then on the asset side, of course, those cars are worth something, but they're worth less than the amount owed on the top of that worksheet. And if they don't own a house, they're probably stand a fairly good chance of being insolvent. Now you have to add up all the categories, but for somebody who's not a homeowner, it's going to be a lot more likely to me that they could end up with that calculation showing some degree of insolvency. So their debt, their liabilities exceed their assets. For somebody with a house who's owned that house for, you know, 5-6 years and seen appreciation on it and hasn't tapped into the equity, it's probably going to be a lot harder for that person to show some insolvency and then enough insolvency to eat up the whole $10,000 or $20,000 of forgiven debt. So that's, I mean, that's typically what we look at and what we see in our practice when we're trying to think about different options for people who have debts with the IRS or the North Carolina Department of Revenue. When we're doing that financial analysis, it's really the house, right? It's the house and any other large assets that create a scenario where it's harder to show insolvency. And that's a good thing and a bad thing, right? Because obviously you don't want to be insolvent. You want to build wealth in assets like a house. But when we're talking about relief, when we're talking about excluding amounts from income, you need to think counterintuitively. You need to think, oh, I really want to maximize the liabilities and minimize the assets, because then I'm going to show a bigger amount of insolvency. And so it's sort of perverse from the perspective of trying to exclude income. It's better to have a lot of liabilities and not many assets. And again, if you're not a taxpayer that has a significantly large asset like a house or some other asset, then it's going to be harder. It's going to be easier for you to show insolvency. I don't think that really answers the question necessarily, but that's how the worksheet would play out in a scenario where there's forgiven debt and you're trying to rely on the insolvency exclusion. And this insolvency exclusion can apply to forgiven credit card debt, forgiven car loan, forgiven student loan in this instance. So really any form of forgiven debt, you can rely on that insolvency exclusion. The key is to go through that worksheet to figure out if you're insolvent and then what the degree of your insolvency is.
For that, Arthur. And there was a follow-up question. Is North Carolina insolvency exemption to inclusion of debt as income to comparable to federal, and that a forgiven debt that is provided for in a bankruptcy reorganization plan is then excluded? Question mark.
So if the debt is forgiven as part of a bankruptcy plan, there's a separate provision in 108 that deals with the exclusion of those amounts. So generally speaking, the amount that is forgiven under a federal bankruptcy plan is not taxable at the federal level or the state level. But again, you need to properly account for that information or show it on your state and federal returns. But it's a different exclusion under Section 108 than the insolvency exclusion.
Got it.
That would be in a Chapter 11 case where you create a plan for repayment. So you'll see if you go back to one of those slides, there's a separate exclusion listed in Section 108, but you don't have to go back there. But talk to your tax professional.
Got it. Thanks, Arthur. Another question that came through is for anyone involved in the negotiated rulemaking process, any update on changes to TPD discharge, such as elimination of 3-year post-discharge monitoring period? NPRM has been published and comment period has ended. Any ideas of when the final rule will be published and if it will be effective immediately or beginning July 2023?
Oof, Greg. Yeah, so they actually, that I had a call this morning with a few stakeholders in FSA. They're anticipating that the rule will be published tomorrow, actually. And so just keep tracking the Federal Register for that rule to be published. I do believe there is an unpublished rule. If you just type in permanent disability discharge, it will show you the unpublished rule that you can review, and the published rule will be released tomorrow, to my understanding. Anything can change in a matter of 24 hours, as we know.
Appreciate that, Jaylon. And just to go back to my previous question, Arthur, when you say homeowner, that means someone who is not paying a mortgage, et cetera, right?
I'm sorry, say that one more time.
It said when you say homeowner, that means someone who is not paying a mortgage, et cetera?
No, it could be somebody paying a mortgage. So, if you take out a mortgage and it's a 30-year loan and you've paid down on the mortgage for 10 years and you haven't drawn on the equity you might have in the house, I consider that person a homeowner, because technically, on the legal documents, they're treated as the owner of the home, although there is an outstanding debt that is sort of like a lien against the house, right? The mortgage. So in my mind, when I say homeowner, I mean somebody who has a mortgage on a house, and then somebody who owns the house outright, and there is no longer a mortgage on it. There's no outstanding obligation against the house. But, you could be, that equity is treated as an asset. So, if you have a 30-year loan, you took it out at $300,000, 10 years in, you owe $200,000 in the house, and you've seen some appreciation in the house over that 10 years from, say, $300,000 to $350,000. Well, then you have a whole, in my scenario, I just forgot, somebody was waving at me. In my scenario, you have $150,000 of equity in the house, and that equity is treated as an asset, because the thinking is you could go out into the open market and you could sell that house for $350,000 and then pay off that $200,000 that's left on the mortgage and walk away with $150,000. So that equity is treated as an asset when you go and you do this calculation of insolvency, showing your income, your liabilities, and your assets.
Got it. Thanks for that, Arthur. Next question is, the North Carolina General Assembly has expressed no interest in making Biden's student loan forgiveness not taxable. And I've heard it is highly unlikely that the North Carolina General Assembly will return for a special session before the end of the year to address it. So any hope that taxability of the forgiveness could change if forgiveness happens by January 2023?
I'd say there's little hope, but again, I do think, again, setting aside how you feel about the loan forgiveness, from my perspective, this just makes it a lot more complicated for borrowers who get loan forgiveness when they're filing their taxes. And I think anything that impedes a taxpayer from properly filing tax returns is something that that I think the legislature, and I know the governor has expressed interest in changing the law in this regard. I think they really need to go back and think about that particular issue if they haven't, which is we want to make the tax system one where people comply, and compliance is easy. And to me, this just doesn't do it. It makes it more complicated and harder for taxpayers. And maybe the legislature has a strong desire to increase revenue. Again, this just makes it harder. And I think this person with their comment is probably right. They're probably not going to come back into session and change the decoupling to make to conform with federal law, section 108 F5, and make this non-taxable. So it is sort of baked in at this point.
Appreciate that. And I do want to go back to PSLF for a second, because I know the waiver is set to end on, at least to my knowledge, on the 31st of October. But regarding the PSLF, Arthur, you had a slide that said that people working in nonprofits, military, or government jobs could get their debt forgiven because of the temporary waiver of eligibility requirements of PSLF. And this may be a question here for you, Jaylon. Will PSLF end this week, or does it continue after the waiver program concludes?
Yeah, great question. So after the waiver concludes, this was a special waiver. This was a waiver that was allowing us to consolidate a lot of loans to that nature. Now, what's getting ready to happen is this: PSLF will continue for a while. PSLF will be here unless Congress decides they want to dismantle it. And that is a option that is actually on the table here that we're looking at federally with the flip of the House next year. But it will have to go through a lengthy process to do that. But one thing I do want to make mention of here is that, and let me pull this back up here. There will be some changes going forward after the waiver has ended. And the new changes to the program will be as follows. Here it is. They want to make sure that borrowers receive credit for years in repayment. So after this has ended, beginning in November 2022, borrowers who have made 20 years of payment, 240 monthly payments, or 25 years, 300 monthly payments worth of payments through these changes will start receiving their loans discharged automatically. So the changes that I just stated will be they want to remedy any of these failures. The department will grant credit towards IDR and PSLF any month in which a borrower was in repayment status, regardless of whether the payments were partial or late, the loan type, or the repayment plan. Any month in which the loans were eligible repayments, deferment, or forbearance status prior to consolidation. A month while a borrower spent at least 12 months of consecutive forbearance. Months while a borrower spent at least 36 cumulative months in forbearance, and any month spent in deferment, exception for in-school deferment prior to 2013. So what they want to do is make it a little bit easier. So they're doing a little bit of consolidating, but there will be some automatic discharges if you have already made these payments for those 20 to 25 years. And I hope that makes sense. And if you have any further questions about that, we're getting ready to publish on our I can actually send the link in the chat to this announcement.
Appreciate that, Jaylon. And my last question on PSLF, and this is for you, Arthur, is the treatment of cancellation of debt under the Internal Revenue Code or state tax laws affected by whether you get PSLF forgiveness under the PSLF waiver or under the normal PSLF program?
It shouldn't be affected by whether you did it under the waiver or the regular PSLF program. You're still relying on the same exclusion in section 108 of the code.
Okay. Well, that sounds good to me. Well, we have come to the end of our time together. Thank you to our presenters, Jaylon Herbin and Arthur Bartlett, for their time and the information that you shared today. And I also appreciate you, the attendees, for your engagement and great questions. And don't feel like you have to remember all of these things that were presented today. I will share the recording along with Arthur's slides. I know the tax code is a difficult thing to understand. So definitely, if you want to take a deeper dive into it at a later point, you will have the ability. But yeah, in closing, I just wanted to leave you all with 2 items today. First, I hope you all leave with a better understanding of the debt forgiveness announcement and its tax implications for North Carolina borrowers. And I also want to urge you again to join the North Carolina Coalition in pushing North Carolina to set standards for services in our state, especially with all the changes on the horizon. In addition to joining us in our push for services standards, I invite you to join as a member of the coalition. You'll receive updates on lending policy at the state and federal levels. You will also receive call to actions to support or oppose policy, along with the invitations to webinars like these, lobby days, and other events related to accessible, affordable credit. And that link will be dropped in the chat. But that is it from me. Thank you again to Jaylon and Arthur for your presentations and to the attendees for your engagement. And I hope you all enjoy the rest of your day.
Thank you.
Bye, y'all.
Thank you.